Commercial property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
And it certainly does do that, covers all things commercial investing. Phil Tarrant, co-host of Inside Commercial Property, joined by my co-host, Scott O'Neill, Rethink Investing, the guy, director, founder. What other titles you got? Chief bottle washer?
Yeah.
Anything that's required?
Yeah, used to be a bottle washer.
Yeah.
5 years in a pub.
Yeah, have you actually done your time in a pub?
RCG, yeah. Pulling,
which pub do you work in? Would have been some fancy one somewhere.
No, Cronulla Sharks. Yeah, 5 years there.
Just pulling schooners.
I used to do the graveyard shift, 12 a.m. till 6 a.m. on the pokies, cleaning up ashtrays.
That's a horrible job, isn't it?
Yeah, it was character building, that one.
So you actually have to sit there and do all the gambling, just watching?
No, that was before I progressed to that. It was literally cleaning ashtrays. That was
just walking around.
Yeah. But it was double time, so means to an end.
Was that why you were studying?
Yeah, that was uni days. So,
yeah.
But it was, I just remember it was, you felt like you had, I don't even smoke and I hate smoking, and that was just like
a miserable job.
Yeah, couldn't. And then they changed the rules, so that was good. So
smoking. So then you progressed to barman, did you?
Yeah, and then it took about a year of doing that. Then playing with the actual pokies where you what I can't remember what you call it. You basically like deal with all the technical side of it. So you fix the problems when they get jammed
and how dodgy were they? Like poker machines.
Oh,
they pay out much?
Oh no, you see people put $100,000 a year into it. Like they used to stick their credit cards into the buttons, and 2 credit cards at once, 2 $5 machines just spinning. And you talk to all the patrons, and you just you often say, well, why are you doing it? And they're just like, well, I don't want to die with the money. It's my right to do it. Like there's that kind of attitude with a few, and they're just addicted. They chase it. Boredom was the main one. I think they just went there. They like the noise and the buzzing.
Sounds a lot like commercial property investing.
Yeah.
So what's the one thing you learned from working the pokies and pulling beers at the Sharks that you use daily as a commercial property investor?
It made me never want to gamble. And like I'll do the odd sports bet thing if you're watching a game, but I know the house wins, and it's so ridiculous to me to put money into it because it's guaranteed to lose.
Yeah.
And I've just seen thousands of examples. So gambling got very boring for me after that. Even when you're drunk, nothing else to do. It's like, well, why would I put $50 into it? I know it's going to go, or there's a 1 in 10 chance I'll get $70 out of it. Like,
so what you're saying then, to generalize and summarize, is that your money is probably better off in a property asset rather than in a poker machine.
Of course. There's a reason those buildings are so big. It's not from footy tickets.
Yeah. Anyway, we digress, but it's good to see you, mate. We catch up once a month. We do Inside Commercial Property. We've been doing this for a number of years now. I've really enjoyed it. I must admit my knowledge around commercial investing has grown considerably. So thanks for your insights and advice over many different conversations that we have. But much like yourself, I'm a commercial property investor, not to the significance of someone like yourself. However, we both invest in property, and property is a game of finance. And we're in a market right now which is certainly in flux. Whether or not we're at the end of this upwards interest rate cycle, the jury is still out. We're going to know what's happening shortly. Whether or not we are at that terminal rate or whether there's a little bit to go. But I think the consensus is, Scott, that we're probably at or towards the top, and a lot of the economists are actually pricing in falls towards the back end of next year or even earlier, back into this year potentially. So who knows? But we like talking about mortgages. I don't know anyone that likes mortgages. Most people would rather not have a mortgage. It actually means death pledge in French. So I don't know anyone that loves having mortgages, but they're a necessary evil for ensuring you can be probably most productive as an investor if you're using the one of the marvels of the world of leverage, right? To do it, there is some cash buyers out there doing stuff, but most of us do have home loans. So we thought we'd get someone into the studio to help us out with this. And if you're tuning into this via the YouTube or any of the social media channels, welcome. Thanks for coming along and checking out. And you can probably see Pham here. He's from Rethink Financing, which is part of the Rethink family. He's your personal broker. Does your mortgages? Yeah.
So
Plus everyone else's.
it was about maybe about 7 years ago. There was I had another broker I was working with. He was a little bit less experienced. We're doing commercial loans, and many of our clients were as well. And we were having trouble with that broker. And this guy who worked for a different company was the fix-it man. So when a deal blew up, I'd call him and say, please fix it. We need the client sorted. I need myself sorted. And I don't know, he did probably like 20, 30 of these. And that other guy left the industry. And then I asked, do you want to come over and join Rethink and run the show over there? And I was surprised he said yes, because he was his own broker and did his own thing. And fast forward to 2023, he's done thousands of deals for clients. One of the best commercial brokers in the country. He does my 6-month process of a refinance regularly, which I don't pity him to do that, but
I could have probably imagined how complicated that is.
Yeah, but he's sorted us in tight situations. Even when I bought a house in Sydney and APRA changed the rules, I remember calling him at 10 o'clock at night going, how much money am I going to lose? Am I totally stuffed here? And he found a way to fix it last minute, so that saved me from an embarrassment.
Down to the wire.
Yeah,
It was hairy.
Yeah.
Well, I did a podcast recently on the Smart Property Investment Show, which is part of the Property Investment Podcast Network, where you're tuning into this, and with Mark Burris, who is probably one of the most well-known sort of people around mortgages in Australia. We had this proper sort of, we love broker moment, where he were what was he calling him? He's sort of like national treasure. He was calling brokers a national treasure, and I was sort of calling them critical infrastructure, which is sort of channeling this idea of what is required in order to continue to advance Australia, and mortgage brokers, write 70% of all loans now. It's a huge amount. So critical infrastructure is a bit of a technical term, but they are the backbone of the bedrock in many ways of property markets in Australia, and one of the great reasons why Australia is a great place to be is that the health and security of our banking system, and how that sort of interfaces with property, and how most Australians hold their wealth in property. So guys and girls like you, Son, you're there at the very heartbeat of this nation, making sure Aussies can get mortgages so they can build their dreams, whether it's owner occupiers or property investor. But it's a tough market. So,
It is.
I really today want to talk to you about what is the current state of play, mortgages specifically around commercial property. Anything you're seeing that's working well? Any sort of secret sauce that you hold tight and no one really knows about? I'm going to try and get that out of you. And just generally, do you actually like mortgages?
We do. I do love it. If you know what I'm like, if you're a client of mine, like you can get me nearly at all hours of the day, except when I'm sleeping.
Yeah.
But
brokers don't sleep, by the way.
Constantly thinking even in my sleep.
Yeah.
But like I'll still be up after hours, put the kids to bed, and I'll be up tapping away, just working on some deals, because all day I'll be on the phone talking to clients, and then after hours I'll sit down and actually do some work, process, get my team to help me out with some things. But totally love it, totally enjoy it. I wouldn't be here doing it with Scott if I didn't, because it's a full-on game, and commercial is a little bit trickier, and that's why I love it. No two deals are the same. Every client is different, and it's about understanding your client, what is it they're trying to do, and trying to navigate the policies of all the lenders. A lot of clients just see a rate and, I want that rate. But you can't go there for this reason, because your situation is a bit unique or different, and that lender's policy doesn't like that. So it's a game of puzzling, just trying to put the pieces together.
So outside of a check, which is good when you get a deal done, that's how brokers get paid by the lenders. So where's the satisfaction for you? Is it getting a deal over the line, like winning? Is it the hey, I've got this one sorted?
Yeah, pretty much. So our first contact, you speak to a client, you say, hey Phil, what's going on? Tell me about your situation. They tell you about your situation. They go, what are you trying to do? And then, all right, you start gathering all the information. You do your servicing. Right, it won't work here. You'll go over there. But then there might be something else with their situation that might be a bit of a hiccup. And so, when we finally get that right lender, speak to other bankers. We're happy to do the deal, put it through. And once you get that approval, it's just like, yay, that it's going to happen. So that's when satisfaction comes in, because we know that we're going to help these clients get that property that they want.
So how tough is commercial lending at the moment?
It's tougher
Yeah.
than what it was 12 months
It's always
ago.
been tough, right? It's
Yeah.
never easy.
Oh, well, no, it was pretty good a year ago when
Yeah.
rates were really low. But definitely in the last 12 months, like all of our guys, all the brokers, it's a lot of work in the last 12 months just trying to get the service, because every month when you do servicing, it's valid for that month because interest rates have gone up. And when you speak to a lot of bankers who've had experience for 30 years in the industry, they're like, well, they've never seen it go up this fast so quickly.
Yeah.
And every month we're just scrambling to like redo. So one minute we're saying, oh, you can do $1 million, and then next month it's less and less and less and less. And then you get the double-edged sword of increases to standard of living. And so that was a double-edged sword for us, because now we have to increase living expense measures. So that really hurt. But we're still getting good wins right now because what you find when things are tough, prime lending like major banks, etc., they got low LVRs, interest rates are good, but it doesn't let you help you get to the next stage, which might be acquiring a property. And so we go to like your alternatives, your non-banks, whose policy is a little bit more generous, and they allow you to, do the funding. Yes, it's a little bit more expensive, but you got to look at it, in the scheme of things, right? So we had a really, and we're seeing it a lot right now, clients purchasing last year. I have one client who we're actually doing right now, purchased for 2.1 in WA. The rate he got it at was about 4.6 at the time, which is still 2% higher because everything was around 2 something at the time. The reason why we took him there was because he wanted a higher LVR, because he didn't quite have the funds to do the typical, 65 or 70% LVR, because anything above $1 million is typically, 65, 70%. He could only do 75, right? So I've got a specialty lender, took him there, paid a 4.6. Now fast forward to today, we've had, 3.5% interest rate. So he's crying, right? He's at 8%. However, the good news is we've had a reval, right? I said, look, I think your property's gone up in value, right? The lease is stacking up. We can reval. He did. It is now worth 2.4, right? So it's gone up 300K in 12 months, right? So for that incremental interest rate, yes, that he's paid, he's still ahead, because if he's paid an extra 2% on a $1.5 million loan, that's $30,000, right? But he hasn't paid $30,000 in 1 year. It's just been for a period of time. It is tax deductible, but the big winner here is he's got that 300 grand in growth, right?
And that's timing the market rather than time in the market. It's good to get both right, but and it's cost of doing business, right? You can either sit on the sidelines and not play, or you can get stuck in and look, it might be expensive for periods of time. You talk about this sort of double-edged sword of the rapid speed in rate rises means that it's eroding people's serviceability, but running a lockstep with that is rising costs of living. So you're getting hit twice, right? I imagine for you, Scott, that poses challenges, because if you're having to rework pricing every single month, people want to move fast. If they're ready to buy, they're going to want to buy, right? But if you can't find the right stock for them to buy, it's just eroding their ability to buy at a particular level. So that's another layer of complexity put into it. You finding that a lot?
Yeah, so as a buyer's agent, you've got to be very conservative in this market. So if a client comes to us and says, my budget's $3 million, like we're generally finding properties at 2 to 2.5.
So you put a bit of fat in there at the front end.
Yeah. And look, sometimes a client can push it. Like they might have a strong business behind them, or, they've always got a little bit of money they don't mention to you just as a buffer. Like, you have a chat with them, you build a relationship with the client, and you can plan that together. But yeah, it's generally not a market you go to the wire. You keep the buffers, because valuations can be a bit more conservative. Banks can just randomly say, I'm going to offer you 5% lower LVR. Or like Son mentioned, the whole serviceability calculator is compromised at the moment. So we have more deals crashing at the moment. That's our biggest negative. As
a result of finance.
Correct, yeah. And it's many different types of finance issues. Like I'd say valuations are part of finance. The LVR issue, and even just the delays with the banks are so slow at the moment. So you miss deadlines. So there's a bit of that going on, and that's all contributing to the market being weaker than it was last year, which you can see it. The prices are, probably about 75 basis points better on a yield. So mentioned that last time. If it was a 6% yield last year, you're probably buying that property at a 6.75 net yield. So there is a advantage on the yield day one because of all this.
Yeah.
Finance has caused it. And the sentiment's still good. Like the buyers are there. They're actually getting held back by finance, not sentiment.
And I sort of spoke about this, people that, don't need mortgages. They're still out there hustling hard, right? They're not. So they're able to move a lot more nimbly and decisively, right? Because they're just cash buyers.
Correct.
Yeah.
And that was the little gripe I had last week. We're just seeing the cash buyers have ignored the market. A lot of, I'm generalizing, but there's some that are just paying way too much for assets just because they're parking money up. They're skipping the whole finance process. Agents love them because they're literally, it's just money for jam, really. It's just buy it, no DD or very little, no finance, no valuer, just buy it. And unfortunately, we don't play those types of rules because we want finance. Like you need finance to maximize your cash on cash return. So even if you've got $100 million in the bank, you'd still get a $100 million loan on top by 200 million. So
well, and that's that $100 million in cash, right? Like you pay that out, but if you've got that in debt, it's all tax deductible, right? So this is when you need a really good accountant, which we spoke about getting an accountant in, have a yarn. We've done that. So Son, how slow are the banks at the moment?
It depends on which bank you talk to.
Okay, let's split it between sort of the big 4 or 5. We'll include Macquarie in with that. So
yeah.
So Westpac, St George, ANZ. Westpac, CBA, ANZ, NAB, and Macquarie. The majors.
Yeah. So it all comes
do
down
deals?
to they all want to do deals. Everyone, the interesting thing is everyone's slowed down, and so they do want deals. We're getting bankers calling us left, right, and centre saying
They're calling up saying,
because they know we're right, and so they're just like, I haven't seen a deal from you for a while. So they, in a way, they're reaching out to us.
They kicking incentives your way to pass on to clients by way of attracting business.
So,
you see it in the resi space. You see it in the
correct.
commercial.
So in the commercial space, look, because we're big writers, we do a lot of write with certain lenders. Because of their policy or whatever, they come to the party with rate. So what you'll find in the industry on average, you're probably looking around 6.7 for a commercial deal, but we're still able to secure probably a low 6, and even maybe a high 5 if we're lucky.
With the majors.
Right?
And what sort of debt sort of rate is it?
So
big numbers.
You're probably looking around 65, something like that.
Okay.
For I guess, or even a 60 for a 5 in front.
Yeah.
But it's all to do with the risk profile of the client, and the property itself. So they look at the client, which I call the sponsor. They check that all out, and then your LVRs, the location, the asset, the lease, all of that. And if they're happy with it, they can give you better pricing. Sometimes some lenders are aggressive because they've bit priced out of the market in the last campaign or something, and they've lost a lot of business to, let's call it NAB, and so they come in with a promo, to get some of that business back. So we've already been told by one lender that they're coming out with another promo soon.
And some of those promos might be, for example, there's no establishment fees,
correct,
right, which could be thousands of dollars, right?
Correct.
That's an easy thing for them just to write off.
Yeah, so we've got one lender at the moment, well, actually a few now. So one lender's publicly come out saying, no estab fee up to a certain amount, no valuation fee up to $5,000. It's a great proposition, saves thousands of dollars for our clients. Doesn't suit every deal though, but if it fits, you've got that. And then because of that, you've got other lenders who haven't publicly said we're going to waive the estab fee, but to win the business, they're willing to waive it, right?
But they wait for you to ask, do they?
Yeah.
Okay.
So we encourage clients, if they are going directly to a lender, to negotiate those fees. But every deal we do, we ask the banker, hey, can you give us something on this? And we usually, put 2 banks together. So we'll go out to the general market. If it's, a $5 million deal, whatever it is, we'll go, right. We send it to all of our bankers in the top 4. And we say, hey, this is the deal. And we just kind of knock them all out. And the last 2 standing, I kind of peg them at each other. Oh, this guy's doing that.
So you create competitive tension, right?
Correct.
Yeah. Do they know who they're bidding against normally? Or you keep it pretty tight?
I tell them. I tell them because we have a good relationship. And the bankers know at the end of the day, look, we do what we do for our clients. It's not like, I hate using you or whatever, and I'm just using you to win deal over here. we write deals.
You don't
with
need to
everyone.
like your banker. Let's be fair. As long as they...
Well, no, we love our bankers because
Yeah.
they give us love, and it's the only way to do business.
And this goes to the I guess the cloud of a mortgage broker, right? If you're just going singular directly to, I wouldn't even know how you get a commercial loan from a bank branch. Like you walk in there and say, "I can have a commercial loan." They're going to go, "Don't know what to do," right? So, but like, what sort of level of relationships you have at these sort of these banks? Is it a business bank, I would imagine.
Yeah,
You got
business
senior
bank,
people who are
correct.
decision makers. They've got delegated authority to actually get
Correct.
deals done.
Yeah. So certain banks have like a premium space.
Mm.
So you got premium brokers for the commercial space, and they give you a bit more love and attention, more resources behind it, and they answer your calls a lot quicker. They come to you like, so we put a deal in front of them. We expect like an answer, hopefully that day.
Yep.
And if you're a broker who doesn't really roll out commercial, you don't get premium banking sort of.
You get stuck in the queue.
Yeah, you get stuck in the queue, and it's a bit longer.
Yeah.
And so the bankers are very critical to us in our relationship. So if we get a banker that we're not happy with, I'll make it known that, look, we're not getting the attention or the emails coming back to in a timely manner. Can we please speak to someone else?
Yeah. And all you want from them is speedy responsiveness to support your clients. You don't want them to send you a bottle of whiskey at Christmas to say thanks for your business, right? It's a bit old Christmas ham, right?
That's right. Yeah, we just want a quick sort of high level answer.
Yeah.
So we normally send the deal saying, hey, these are the parameters. What do you think? Yes, we're happy with 65, 70, whatever it may be. Great, tick, and then we go speak to our client. This is what we kind of have. Yes, all right, let's get moving. Provide me documents, blah, blah, blah. And then, we find the answer.
I'll put you on the spot. Who's the best bank to deal with at the moment?
Ooh, good question.
Recording this very late in March.
Oh, look.
We know all the banks are okay. So. You send your mail to Scott, info@rethinkinvesting.com.
Yeah, that's right. No, I hope they're not listening. Nah,
don't worry, they're listening.
I guess it really depends on what we're trying to do. But we love Westpac at the moment for our lease stock products.
Okay. I was going to ask you about lease stocks, but anyway, we'll get to that in a moment.
Yeah, because that is just a very quick, simple, easy solution. We can ignore a lot of the client's personal position, and we can just get the deal done.
Westpac's always like lease stock type stuff, right?
Yeah.
Yeah.
I personal opinions, I think they're the leaders in it at the moment.
Okay.
Yeah.
Well, there you go. Westpac, there's a free plug for you.
We do have other lenders who say, "Oh, we're coming out with a really good pure lease stock product." Okay, I'll wait.
What's the easiest business to write at the moment? Like at what level? Like dollar wise. So let's say 60, 65 LVR, so good, safe business.
To be honest, I actually think a non-bank is better.
Okay.
In terms of getting the deal done. Because
quickly or getting a deal, just getting it done.
Getting it done. Okay. So quickly, no. So the non-banks we use is like a full doc.
Yep.
But their policies with servicing is really good. Assessment rates, right, is a big problem. Resi, you've got 3% assessment rates, right? Commercial is a bit lower. And what you're finding in this environment too is this is why we think the environment is getting better, because buffer rates for commercial are coming down.
Can you explain what a buffer rate is?
Yeah, sure. So when a client goes for a loan, they take the base rate. So the base rate's called 6%. They'll add on 3% in the resi world.
Yeah.
So you're looking at a 9% assessment.
Yep.
So that loan now has to be, call it $1 million, has to be assessed at 9%, which is $90,000 interest only. Does their income cover that, right? But in the commercial space, Westpac as an example, they recently reduced it from 1.5 to 1%.
A buffer,
right?
So that's 2% different than
100%.
Resi. And what's their logic for that?
Well, they've also got an ICR coverage,
yep.
Right? And so this ICR, let's call it 2 times.
You better explain what ICR is.
Yeah, so ICR is interest cover ratio. So let's call it 2. Your rents that you receive has to cover their interest at 2 times, right?
Yep.
So that's also come down. So with all these interest rate rises that we've had, they've had that buffer in place, right? But now we're at peak and they see it changing and coming down, or there's no more interest rate rises, and that's why they've pulled it back. So the interest cover ratio was higher, it's down to 1.5, and they've reduced their buffer rate from 1.5 to 1.
Yeah.
So that's a good sign that we're seeing that we believe that we're at peak,
yep.
And things are just going to improve now. So that's helped us with lease stocks go from 50% LVR up to 60, 65 if we can get the right yield on the property.
So that buffer rate is very different. I take the logic around the reason why they had the buffer in there was that they needed to be assessing people's ability to repay the debt when interest rates went up from all-time lows, right? That's smart business, right? One of the criticisms at the residential side is that, and APRA, who's the prudential regulator, has come out saying, nah, we're keeping it at 3, right?
Yeah.
So people are getting assessed at 10%.
Yeah.
Some people 10%, 9 to 10%, right? So why is it less in commercial? Does the APRA, because it's sort of more commercially orientated, does APRA's influence not be as significant when it comes to commercial interest rates?
Yeah, good question. Difference is resi is regulated.
Yep.
Commercial is not regulated.
Exactly. What
That's
did you to say? Yeah. Okay, explain that.
Yeah, so I guess NCCP, responsible lending, we have a responsibility to make sure the client can service, which means we have to look at everything, right? But because it's not regulated, we don't have that. There is still responsible lending though. So the banks, they still have
non-regulated doesn't mean bad or dodgy, right?
Correct.
Yeah.
Just I guess a bit more loose, or they're happy to play in the grey a bit, if it makes sense. So again, like just because it's not regulated and they don't have a full look at it, there is still responsible lending mechanisms behind the scenes. But it's a bit more loose, I guess.
Yeah.
And what you find is, you've got things like setting it up in that SPV, special purchase vehicle, because it's technically a separate entity. We can ignore personal debts. We're going to have to look at that sort of.
I guess this baseline philosophy because more Australians obviously invest in residential property, owner-occupier, for example, or property investment, whereas commercial's deemed to be a little bit more sophisticated. So, within residential, they put training wheels on everyone because people make bad decisions sometimes, and therefore the regulator needs to regulate for the masses. But I guess with the commercial property, the idea is that, well, if you actually want to go into commercial property, you need to probably have a more sophisticated commercial nous around you, and therefore you should be absorbing some of the responsibilities, much of the responsibilities around decision making. Whereas in residential property, often people don't know what they're doing, and there's been some horror stories around it. So I get it, right? So if you want to play in a commercial space, and what you present to the lender is, hey, Mr. and Mrs. Lender, I can afford to pay this, and here's my financial, because that's what I presented. You got to be responsible for the delivery of that. But people blow their dough.
Oh, look,
in commercial, they get loans they probably shouldn't be taking on. You got to cop it in commercial. You can't sort of go, oh, it's not my fault.
Yeah,
dodgy broker told me to buy.
we do find that the clients in the commercial space, they are a bit more savvy.
Yeah.
When we run credit files, they're all squeaky clean.
Yeah.
No one bad credit. They're just a better sort of credit client, I'd say.
Yeah. But they take responsibility for their own credit.
Exactly. Yeah. And just to go back on that point about 3% APRA, and this is why we love non-banks, right? Because they're not regulated by APRA. I mean, ASIC's still involved, and there is still responsible lending, but their rules can be a little bit different. We've got one non-bank lender who doesn't have a 3% assessment rate. They've got 1% now.
Resi.
Okay. They had 2%, and now it's down to 1%.
Are you going to name
right? Okay, Liberty.
Okay.
Right.
Yeah.
So they've recently come to the market with that. Existing debt is at OFI, which means existing repayments at actuals.
Yeah.
Okay, so that is a good solution for people who are coming off a fixed rate, let's call it, right, from 2 to 6% P&I, and their repayments are triple. Right, we can potentially refinance it to a new IO term. Even though the rate is, let's call it 6 or 7% currently, you'll find that cash flow wise is still better off. So it's a temporary measure to just get through this period of time. And then in time, when rates come down, which we expect to come down in the next 12 months anyway, hopefully we can go back to a prime lending.
And what you've got there is exactly what a smart broker would do if you actually understand, maybe those challenges. And a lot of people have been talking about this, what they call it, mortgage prison, right? Where and it's what you just spoke to there, Son, which is I'm coming off a fixed rate at 2-point-something% onto a variable rate. I'm going to be paying 6-point-something%. I can't afford it. I want to refinance my loan, but I can't refinance it because I take it to another lender, and my serviceability is not going to allow me to take on the debt, and I can't refinance with the bank that I am currently with because my serviceability won't allow me to take on that amount
That's
of
right.
debt. But so as long as you're still able to pay your interest payments,
Mm.
the bank will be okay with it, right? So you
That's
get
right.
locked. So what
Mm.
you're talking about there is actual solutions.
Correct.
But, there's this idea that non-bank lenders are inherently more risky. You're saying they're unregulated. What do you say to that?
Look, I wouldn't say it's riskier because lending is lending. They're lending you money. It's securitized lending. So they're lending you based on the fact that they hold that asset. And GFC wasn't a classic example. When the GFC happened 15 years ago, there were some non-bank lenders that went belly up, but people don't lose their homes. They continue to pay. What normally happens, trustee steps in, and you'll find that major banks will gobble up that book.
They just buy the book.
They buy the book.
It's going to be technical there, but essentially one bank buys the other person's
Correct.
debt.
So they buy that, I guess, securitized debt, and then you essentially start paying back the mortgage to, let's call it CBA, because they bought that non-bank lender's book. You'll find the interest rate will probably go up a bit because the banks will charge a bit of a premium because they just spent money to buy that book, right? So I wouldn't say it's riskier, right? Because it is securitized lending.
Yeah, and I think if you're sort of intrigued by that sort of stuff, is it called The Big Short? Is that the movie around the GFC?
Yeah.
And that gives you a sense for sort of this grouping of mortgages and grouping of risk where they say, 60% of it is really good people.
Yeah.
20% of it is a little bit sort of, how's it going? And then 10% of it is really, really crap, but you make the most money off that stuff. So
Yeah.
this is how mortgages work. It's a bit,
But the difference is, I guess, Australia, much, much more regulated.
we are because of APRA and what we just spoken
That's
about.
right.
The inherent strength of our banks, what I was chatting about at the start of this
Correct.
podcast, is the fact that they're pretty well regulated.
That's right.
And you're not going to, hasn't happened, you're not going to get a run on the major banks in Australia, right? Their asset allocation is pretty good. Even how much money they need to keep in cash versus what
that's
debt
right.
they have out there is
Capital
another really
reserves.
strong. Maybe we should do a thing on this one day if people are interested on how it all works. But you spoke about lease stock loans. I hear a lot of people are sort of a bit jittery at the moment around lease stocks purely because of the ability for valuations on commercial property to stack up because interest rates are going up, blah 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 blah. They're inherently devalued commercial properties. Is that false? True?
Oh, not necessarily.
Yeah.
All the deals that we've been doing, more times than not, they do come in on point.
Okay.
You will get
So they're coming up at the valuation
as purchase
at
price.
purchase price.
Yep. You will see from time to time it is a bit slightly lower than what the purchase price is compared to resi. Resi is usually, purchase price is the val.
Yeah.
Commercial is, you will see time to time a bit lower.
Can you explain how the banks value up? So the lease stock loan, how a bank actually values up the inherent value of a property based on the lease.
Yeah, so I guess they look at the lease, what it brings in. They got their cap rates and everything like that. So they look at the location, who the tenant is, longevity of it. So there's all these measures that they put in place for it. But I guess at the end of the day, it's the valuer that's doing it, not the bank. But the banks do instruct the valuers what they're looking for, and then they go out and do their comparisons, etc. So
simplicity, in a simple way, because I'm a simple guy, they just go, how much rent is this thing generating? Who is the tenant? How effectively they pay their rent, and for how long have they been paying it, and for how long into the future based on the lease? And they go, yeah, this can pretty much
there's a few data points.
wash its own face.
Yeah.
Therefore, we're happy to lend against it. That's a lease stock loan.
Yeah.
So it means you don't have to provide all your other stuff. They just do it in isolation.
Correct. So as long as as long as it's considered as market, right? Because sometimes the passing rent is what they're currently getting is a bit too high than the market. That's where the val might come down a bit.
Yeah.
But let's say it's the same. Yes, and if it covers the ICR metric with buffering, it's a done deal. Can ignore everything else.
You got to be really careful with this because, and you must see this all the time, Scott. And when you're doing your assessments, that the face rent might sound really good, but it's incentivized up the yin yang, and what you're actually getting in your bank account is something very different. And you'll see it whenever you're in a commercial lease negotiation. It'll be negotiated around, this is the rent, and then we'll give you this stuff on the side.
Yeah.
But this is let's make this a number, and they do that for valuations, right?
Correct. So the first thing we look at whenever we look at a deal is the rent. So we've got big databases at Rethink Investing because we see hundreds and hundreds of valuations. So we just pretty much save them all, and so we've got our own data points. So if we're looking at a retail shop in, I don't know, Adelaide, we know roughly what the rate should be, and we got all the comparables
Per square metre.
Yeah, and we know what the incentives are needed. One of the accounting tricks, or it's not even a trick, it's just what they all do that the big funds do, especially in the office market, is they do very high incentives, lift the face rent. It can be 30 to 40% of the entire rent. And it's almost like if you take that out, there's less income there, really. So they do that to kind of help with the capital value of the asset. It helps the book value, which obviously helps paying out investors. And this is why a lot of people think there's a bit of risk in some of these funds at the moment, because the value, they often do like an annual review, and they need to get the val up, and then they pull out equity and they use that to pay the investors. That's a problem when you're buying let's say your investor needs to get a 7% return and they've bought a tower at a 4% yield. So they're using 3% growth just to top up the investors. So that's risky stuff.
3% growth in the capital value to extract that out to pay the investors down.
Yeah,
you sit there and just go, it's house of cards.
Yeah, in cash flow. So imagine it doesn't grow for a while. And then where are you going to get that extra funds from? So what they're doing at the moment is selling. So we're seeing funds, it's almost a two-speed market. Your individual investors like us are aggressive. We're seeing value. We're seeing prices still rising. That's, call it under 10 million. And above that, funds are not buying, and they're not buying from each other at the same rate. They're actually selling. So that's how they're getting their equity, selling off their kind of cheaper assets, their ones they don't want. So you're going to see lower growth in that level of building versus the cheaper stuff, because the demand is just different. And that's caused from, I guess, the differences in, the yields. And the valuations aren't going to be going up as quick. They're relying on rental growth. So that some of the industrial funds are going to do quite well. Office funds, not so much. Retail is going to be in between those two. And it's a fascinating space. I think they're going to rely on rates to drop to get the returns for their investors, some of these highly leveraged funds.
Yeah. And on that basis, Som, would you, if you can do a traditional vanilla loan rather than a lease stock loan, would you go that way as a recommendation over lease stock if you can?
100%. So it depends.
So is the lease stock the loan of last resort?
Kind of. So every client that we get, we always ask them, we need to understand their situation. It's our responsibility as a broker, I guess. So we talk to them, understand their full financial position, and we see if we can do like a full doc sort of loan. If we can't, then lease stock, all right? You'll find that you can do full doc probably most of the time, but again, that's going to like a non-bank where the interest rate's a bit higher, but you'll get your 70s, 75, 80%, whatever. But the ones that want a good rate, okay, 65, 60. But yeah, we do look at full doc as a first option if possible. Yeah. Some clients come to us saying, look, I've got too much stuff, too complicated. I just want simple lease stock.
I just can't be bothered doing it.
Can't be bothered. Yeah. I got one like just yesterday, he wrote to me, I got 1.3 ready to go and I don't want to be put through the ringer. What's my lease stock option? And I just told him what it was. Right. So
what sort of rate you get?
Low 6.
It's not bad.
Yeah, it's not bad.
What sort of asset is this person buying?
Well, I'll leave it up to the investing guys, to find him something. But I've given the parameters of what he could go for, assuming that interest rates don't go up again. But if there is, there's a bit of buffer in it.
Who's buying commercial property at the moment?
Everyone.
Generalize for a
generalize,
moment.
all right.
Yeah. And we're talking about not the big funds and stuff. We're talking about punters like us.
Sure.
Yeah.
Okay. So look, mums and dads are probably slowed down a little bit. Mums and dads at PAYG, they're probably hurting a little bit. The ones where we're still seeing good, strong demand is trading businesses. So people who run, a small business, good net profit, servicing is not a problem.
Okay.
So they're still willing to buy because they're cashed up, just like what Scott said. They want to park some money somewhere.
So they're taking it out of business profit, parking properly.
They've got net profits.
They've just got net profit.
Net profits, and they've just built up that net profit over time. It's just sitting in a bank account. They've got $4 million, $3 million ready to go. So there's some people out there cashed up. Again, not everyone, but they're probably ones that are really strong at the moment, and not an issue with funding. The mums and dads are still wanting to buy. We're still being able to place them, but it's a bit of a trickier conversation because they're worried about rate. And I keep saying to these investors, look, you got to look at the long-term picture. Whilst the interest rate is high now, you're going to get that growth on it. Just like that client of mine last 12 months, 2.1, 2.4 now. Because of that spread, we can now go back to a lease stock and get him the low 6. And now I can save him that 2%.
So he's not taking on any more debt.
He just wants to refinance.
He just refinance it out at a higher LVR.
Correct.
And therefore get a more mainstream lender.
Correct.
Yeah.
So he's going to save some money now. So the good thing is, look, we got him in because he didn't have the funds at the point in time.
Yeah.
Property's 12 months later, property's grown in value. You've got that equity. The LVR is lower. We've done the vow. We can refinance this as a lease stock. Good yield. Away you go. Right? He's happy as Larry. You know, because he bought a good asset.
Does it take a lot more time, energy, and effort because you're full doc with a major lender who's going to have to bare his soul, right, and give everything to get all that sort of stuff? Is the juice worth the squeeze?
Yeah. So look, it is a lot of work for us, but it's a satisfaction, I guess, at the end of the day, because we know that client's going to be a client for life. Yeah. Right. They're going to always come back to us. We always do their lending, so there's always potential out of it. Sometimes right now as well, some of our guys, we're doing a lot of work with just pulling out equity, ready to go for the next purchase. So, you know, resi loan, collecting all docs, go through the whole process, pull out $1 million, sits in offset. Guess what? We get paid zilch, right? Net of offset. They change the rules. Brokers get nothing. So when our guys tell our clients, oh, you know, pull out $1 million, and they think we're getting paid for it, no, we don't, right? Until they use it later, right? So we're parking it ready because we know that when they do come back in time, we'll get paid, whatever, and we'll do the commercial loan, etc. But the funny thing is, some of these specialized non-bank lenders, they don't want you to be on their books for a long time. They want you to get in, they make their money, and you get out. So it's like a halfway house, a stepping stone solution.
They're conscious of that, and they build their business around that idea.
That's right.
Yeah.
Hence
the reason why I pay a few more bucks on the way in, establishment fees, and
because they know no one's doing, you know, 75% above $1 million. Let's say there's only a handful, right? So they know the market, they know where they sit, so they're prepared to pay a little bit, charge a little bit more, and clients, happy to do that as well.
What's the arrears like on those sort of deals? Are they sort of standing up? People paying their loans back?
Yeah. People paying their loans back. You find interesting as well, like low doc. The low doc arrears is typically lower than a full doc. Okay. Right. And that's funny because low doc, you're not really looking at everything. Yeah. So it's an interesting beast.
And is it what people who have low docs are maybe a little bit more financially savvy? They know what they've got to do and they meet their commitments, right?
Because they're business owners. Yeah. Their livelihoods are behind the business, and they want to make sure that at the end of the day they can still trade, right? Because at the end of the day, if they don't pay their bills, they can't get funding, everything falls apart. Yeah. So you find that low doc sort of customers, they are generally very good at repayments, even though it's slightly higher.
Yeah. But, again, it's cost of doing business, right?
That's right.
If you want to spend the time, energy, and effort to get a full doc, it might be faster to just go low doc and cop a little bit more on the refinance later on when you sort your stuff out. Like that makes sense. 100%. Or group it, right? Like, rather than sort of doing a individual loan every sort of 2 or 3 months, which is painstaking, you can club up, and not providing any financial advice here, by the way, but you can club up a number of sort of low docs with non-banks, and then when you get your financials ready, you can just refinance them all at the same time, right? That's smart business. Yeah. Makes your job easier. So we've sort of been chatting about loans, mainly probably I'd say outside of self-managed super. How is it inside of SMSFs now? There's more lenders back doing commercial stuff in self-managed super?
Yeah, it's an interesting piece.
There's not many operate there, right?
Yeah, not many. We've seen more non-banks come to the party. The banks have all kind of said no. There's a couple of tier 2s that do it.
Why don't the banks? It's pretty safe business.
Yeah, I know.
So
it's
I never really understood it.
I know. So I think their books are quite full from years ago when they did first get into it. They went hard, and I think their books are a bit full. And I think it's all got to do with the whole LRBA, limited recourse borrowing. So yeah, I don't know why right now they're not coming back, because I ask my bankers all the time. It's like, you guys got to get back into it. But the interesting thing is, if you are a private bank sort of client or high net worth client, they will still do it for them, right? Because you've got a big portfolio with them. It's just
they don't want you going somewhere else.
Exactly,
right?
They'll do it, right? Yeah. But it's not generally open to the public, right? But the SMSF space is really interesting because it is $1 trillion industry, right? Everyone's getting their 10.5%, and it's going to increase to 11% next year. So there's a lot of inflows to super, right? And we all love property. If you look at the rich list in Australia, most of them have made their wealth from property, right? So and it's an easier sort of proposition inside super, because inside super we don't have to worry about your living expense because it's inside the super fund, right? All we're looking at is the contributions coming in because that's your income to the fund.
Yeah.
And anything going out, which is generally running of the fund, which would be nothing if you've got nothing in there, just cash fund. And then just the property that you're buying, right? And the rent received there. So in terms of serviceability, it's really easy to do, right?
It is. It's just restrictive though. Like I like investing inside of super, but you put too much in. You never know what the next government's going to do, right? Like they're already sort of rattling their sabers around super balances. You just never know, right?
That's right.
You know, the idea of super is it's not. Well, I think philosophically when it was introduced, it wasn't a mechanism for the rich to get richer. It was about protecting all Australians or giving them a ways and a means to have a better retirement, so they weren't sucking on the teat of the. Of the government, right? You know, for a pension, right? And that's cool, you know, and I don't want to get political with that. I get all that. But it's restrictive. If you're holding assets inside his super, it's you know, you can't do a lot of value add exercises. You can't positively maneuver and manipulate your wealth creation in it. It's a lot more stifled, but that's okay from a minimization of risk, right? And your accountant can help you with those decisions.
Yeah, so I guess like outside of super, we can always leverage off the equity. Inside super, you can't do that. Yeah. So it's literally buy one asset and pay it down essentially, or have interest only. Yeah. If you do pay down some of the debt, you can't actually redraw it back out. No. And so for the clients that we have that want to buy multiple properties inside the super, we just say, look, structure it as interest only without giving financial advice here. You know, you could put on interest only, free up your cash flow. So then more of that contribution and rent is just going into the account. Yeah. And then when that's come to a big,
do something else with it.
Yeah, we can buy another property.
Yeah, and that's sort of advice. That's just one strategy that some people do.
That's right. That's, you know, or we say, look, you can chuck everything into that one, pay it off, and then if you want, you can sell it. You know, the tax on it is quite, I guess, nice compared to, you know, outside because, you know, super is the most tax effective vehicle in Australia. Yeah. And so, they sell it and then they could divvy that up to 2 deposits and then buy 2.
I guess it's where you are also. It's not advice, it's where you are on your superannuation journey. You know, It's no use generating really good cash returns inside of your super fund if you can't access it, right? You've got to do something with it. You've got to chuck it in the share market. Maybe that's not the best idea at the moment.
Maybe not right now.
who knows? But one of these myths that you can't have an offset inside of your super. You can get it.
You can. You can. So... Look,
so it's one way you can use your cash.
Correct. So there are certain lenders that have an offset account, right? Not all. It's an interesting argument because
you do a resi and commercial. You can offset commercial.
Yeah. Okay. So there are some commercial lenders that offer the offset. Again, it's a bit technical because I don't know how some lenders get around legislation around it. Okay. But that's a
we won't name any lenders then on that. I was going to ask you who's doing it, but I wish I could offset.
We've got a couple that do it. So anyways, we can do that as a strategy. So we can refinance whatever. I've got a client that's on 8.6. I'm going to get them down to 6.8. Yeah. And they still got like heaps in their super. We could put that on an offset and then saves them even more. And then when they're ready, we can take it, buy another one, whatever. So, yes, some lenders offer it, but doesn't mean we could always go there as well.
This is more of a long-term strategy question, and myself and Scott spoke about at length the last couple of times we got together. Commercial property today doesn't stack up as favourably as what it did a year ago. It's fact, right? If you're a leveraged investor, i.e. you have a mortgage, so your returns aren't as good. That doesn't necessarily mean because most people are at a 65-70% LVR that people are going to negative territory. Your view, is this just a moment in time? Talk to me about the sort of inherent value of commercial property in this market.
Yeah, look, definitely a snapshot in time. Commercial property typically is, positively geared. Those clients that do 65% LVR, and if it is 35% cash, whatever, they are still positive today, right? Even if the rate is at 8%, right?
That's generalizing.
Yeah. We do have a lot of clients.
Depends how your asset performs, right?
So I'm just looking at, I guess, yield in terms of the rent received if it covers cost of holding. And what you find is, and this is why we love commercial, right? You've got in the leases, you got built in, 3 or 4% fixed or CPI, whichever's higher.
CPI is good at the moment.
100%. And so those clients,
I've got CPIs on mine. Yeah.
So some of those clients that are, got that option, they're exercising it right now, and that's why we've seen lately these yields have come back up.
Yeah.
So we're doing a few deals
That's
above
people
7.
exercising the increase in rent. So it's a
Correct.
structured increase in rent.
100%.
Every year you can
Anniversary.
push it up
Yeah.
7% at the moment, right?
Correct.
That's a big chunk.
So these existing leases, they've got 3 years running on it. They're 1 year in. Hey, it's time to renew. Hey, CPI, boom, increase 7%.
And that's part of the increased cost of operating for businesses in Australia if their leases are going up by 7%.
Yeah.
7%.
So the long-term view is, with these built increases, you'll see that the positive cash flow will come back. We believe interest rates are at peak and they will start to come down.
Who's we believe? Is that you?
I guess a lot of the cohorts in our industry, I guess.
I tend to agree with you, by the way.
Yeah.
I think we're pretty much terminal now.
Yeah, we're pretty much terminal. And again, it's seeing what the lenders are doing with policy. We know that they're kind of they.
What are fixed rates looking like at the moment?
Fixed rates, they're not too bad.
Yeah.
And that's another indication of why we think we're at peak, because rewind the clock 12 months ago when you've got rates, all of a sudden fixed rates are now at 5% and when variable was still at 2 or 3. That's a big sign that, hey, they expect massive increase. But right now we're finding variable and fixed rates are becoming almost on par.
Okay.
And I've even seen on the resi side, I've seen one lender put a lower fixed rate than what the variable was.
2 year, 3 year?
That was only 1 year.
1 year. Yeah.
So I was looking at it, whoa, okay. So even that's kind of like saying, well, they probably think it's going to come down as well.
Yeah.
So yeah, look, if the clients want certainty around repayments, fix it if you like. But we think it's going to come down. So run the gauntlet. I think just put on variable.
There you go. Well, you certainly knows about mortgages, Scott.
Yeah, Mr. Fix It.
Yeah, Mr. Fix It.
That's what he does.
He's a fixer.
Yeah.
Yes, that's what Christopher Pine was back in the day. He was a fixer. He fixes things. He was his last job was Minister of Defence, but he was well known for fixing things. So he fixed stuff. Can most things be fixed if you get onto it early enough?
Yeah, I'd say so. Look, solutions are there. We haven't even touched on fully private lending, right? Private lending is like LVR, where you go, no servicing required, right?
So private lending is where the bank just goes, yeah, we want this person. Let's just give them a big line of credit.
Correct. It's all asset based, right? So they're saying you've got $1 million asset. No worries. Here's 60% value. I won't do servicing. Won't run credit checks. Nothing.
Yeah.
Here's your money. Because at the end of the day, if it all goes pear shaped, they just take the asset and sell it and get their money. So
and that's what the last couple of deals I've had have been that, and they've been very different from everything else I've done previously. The banker actually really wants to know the plan of the asset, like what are you going to do with value adds and where's the upside, like how long do you want to hold for it? Like it's really, they're kind of in the journey with you, which I've never had before.
So a private bank's more active in this environment, do you think? How do you get into a private bank? What do you got to be or do? Or
it's really just LVR.
Yeah.
Really. So when I've been in this game for a while now, and what we see is when times start to get tough, people move away from prime lending because it's too hard. Get into more the non-banks, and
it's too hard. It's onerous to do it.
Oh,
and
no,
it's restrictive.
Well,
yeah.
I mean, the process is still the same.
Yeah.
Still got to provide all the docs. It's hard in terms of because where interest rates are. Everything's moved so fast. People's wages haven't increased, cost of living. So all these pressures have made it harder to get prime lending. But for those deals where even I couldn't take it to a non-bank because servicing or something is an issue. Yeah. But the client's got $1 million or something like that, and they really want this asset. They have to have it for whatever reason. Private bank's your option. Private because they don't look at anything, right? They just go, well, I hold the asset, 60% LVR. We'll do the value. It all stacks up here. Where you go, you're going to pay through the nose for interest, though.
Yeah.
But again, the client might want that asset because it's for their business, it's the right location, wherever it may be, and then within time, look to refinance it out. So get their financials in order, or the market drops, whatever, and we solve that solution later.
Okay. Any questions, Son? We covered a fair bit.
Only real quick one a lot of clients ask me is how much would you allow if they got the deposit ready, from a banking lending time frame, just for approval? Because obviously we put off as subject to finance.
Yeah.
What would you allow for with different banks?
Oh, I guess we've always done the 21-day finance. I'd like to see probably 28. But it really depends on.
So 28. So saying I'm going to sign this deal, but I want 28 days to confirm whether or not we're going to go ahead with it.
Yeah, correct.
So it's a finance condition.
Finance condition. So it gives us
And that's
brokers,
not a structural mandated thing. That's something that can be negotiated by your
that's
buyer's
something
agent.
that the investing team will negotiate. Because what you find is every property is different. The location's a big one.
Yeah.
Valuers, if it's CBD, metro, they can do it within 5 days because it's easy for them to just get out there and value it.
Yeah.
But the ones that are a bit out of town, like they'll go, oh, well, we only go up there once a week, and it's a bit of a drive, so we'll charge you.
You know what? Like it's Murphy's law. It's one of these laws, I reckon, where whether you negotiate 7 days, 21 days, or 28 days, it'll always be approved on the last day.
Oh, 100%.
Like it's always going to be. We don't know if it's going to happen. We don't because and then it just makes the negotiation harder for, in your point, the buyer, like the buyer's agent on behalf of the buyer, because it compromises your ability to negotiate on other stuff. And they're going, "What's going on? What's going on? What's going on?" They always expect for it to go right to the 11th hour.
Yeah, I blame the valuers mostly. They see the timeline and they're like,
they push it out, right?
So you got to almost tell them 2 different dates.
So can you influence the valuer at all in terms of, like, I know in resi a lot of people go, they'll meet the valuer and say, look what I've done here, and I've added all this value and all that sort of stuff. Is it worthwhile doing that in commercial? So
100%. So there's a lot of valuers we blacklist because they're just.
So you say, nah, don't want them.
Oh, we see the name and we know what they're going to do.
Like, so you call up the bank and go, I don't want that valuer.
Because he's.
Do they just get stuffed?
No, there's a panel.
Yeah. Okay.
And
we can choose on the panel.
Valuers can be bad for different reasons. Like they might have a personal gripe against an agent that argued with them on a previous deal. So they're deliberately so
there is a bias sometimes,
100%.
whether it's a known bias or a deliberate bias.
People will say there's no bias, but there's bias. And specific agents might be somewhat more aggressive if deals crash or not. And
so they'll call up going, why are you pricing this? You know it's worth
You've
this
got
much.
no idea. Like learn the market, get a new job, all that kind of stuff. So we sort of avoid the valuers that will deliberately be conservative. We just want someone who's realistic. Like look at the real.
You want market,
comparables.
right?
That's all we want. We don't want over market.
But I'd be arguing if for a valuer, right, a deal originated by a buyer's agent, you would assume should be a pretty good deal because the buyer's agent's operating on behalf of the buyer to get a good deal. Like it's not very often, I don't know, maybe it happens where the buyer's agent's putting deals which are out of market, right?
Yeah, look, buyer's agent shouldn't have an effect, but one of the things valuers do is if it's an off-market deal, like nearly 80% of what we do is off-market. Yeah. Some valuers think,
is it really off-market though?
True
people
off-market.
go like true off-market. People go, we do off-market properties. We just
an example is like a lease gets drawn that day, and then that day there's a lease in place. We buy it before it's even like signed,
before it's marketed anywhere, before it hits so if it hits a real estate platform, it's not off market.
No, that's just it's been flogged around a database, so it's not off market. But some valuers don't like off market because they think it hasn't been trialed by the market.
Okay,
they think it's non-competitive, even though as a buyer's agent I think it's the opposite. We've bought it without competition. They just look at it differently. So some valuers don't like off market. Some respect an off market because it's all to do with the cap rate and the square meter rate on the rent. It's pretty simple metrics. So we just work with the valuers that are, I guess, commercially minded, really. And and there's normally 3 to choose from, so it's pretty easy.
Okay, so not all valuers are created equal.
No, there's some good ones and some.
It's funny, right? Like how do you want your valuation to stack up? Well, you want it to be. Sometimes you want it to be more than what it's worth. Sometimes you want it less. It's like it's horses for courses, right? You like a big valuation, don't you, Son?
I just want to come on point, really.
Yeah.
Valuers will never put it more than what the purchase price is.
Yeah.
Just to protect themselves. But you will see them be a bit conservative sometimes as well, just to protect themselves. But yeah, as long as it stacks up, I'm happy.
Which can be good sometimes.
Maybe get one of your friendly valuers in.
Yeah. Or there's my second last purchase. I had a really good guy in WA helped me through it, and we used it to get the price down to a degree. Like we worked together and sort of.
Well, so you could actually go, I'm not paying this because the value's coming in this. You better drop your price. That's when you want your valuation to come in under, right?
Yeah. So you can use it's a really good negotiation tool. So,
but you can't. But you shouldn't really. The valuer's independence is that they should say what it's worth in the eyes of the lender who's going to be putting the debt against it.
Yeah.
So
correct, but you can work together and go. We think that. Like, oh, look, maybe I'm in a different position because we're sort of, we're mass buyers of the market. So we I'm not just some random buyer off the street, but if we look at a rent and go, yeah, that's a bit inflated, let's just exclude that because it's under 12 months of rent. Like you can kind of work together because there's a bit of flex in a val either way. It might only be 100, 200 grand, but that's a negotiation tool.
Cool.
Yeah.
Thanks for coming in, Son.
No worries,
Learned
mate.
a lot. It's a good time to be a broker.
Oh yeah, it's a tough time, but no, it's
It's
good
always
times.
tough. They always
There's
cry,
always work.
cry.
I say
too much work, compliance.
when times are good,
up,
people want loans. When times are bad, they don't want to refi. So we've always got work. So
Yeah.
yeah.
Refinance has been booming, but that's sort of slowing down a bit now, isn't it? But you'll get another kick into it. It's just, that to the point you made, your mortgage broker should be, understanding where you are and where the pressure points are in your financing for, everyone talks about this interest rate cliff. So there is solutions around it.
Yeah,
We're
it's
also,
all about solutions moving forward.
We're also looking for commercial brokers if anyone
Oh, here we go.
is looking.
Yeah, so
We're
we're
desperate.
turning to a recruitment podcast now, is it?
Oh, we need more brokers.
How do you
More
know?
work.
How do you know?
It's hard.
How do you know someone's a good commercial broker?
Ooh, that's
Is
a
it
really good question.
Yeah, like you're obviously looking for them, right? But if you're a commercial investor and you're trying to find a new commercial broker, because there's some excellent brokers in Australia,
100%.
but they're really good at resi. Commercial
yeah.
is a different discipline.
So with all the guys that we've, I guess, hired and brought on board into the business, the biggest thing I look for is attitude.
Yeah.
Right. And
Well, like a can-do attitude.
can-do
like a
attitude,
problem solver.
problem solving, not focused on rate.
Yeah.
Look, rate is important, but I wouldn't say it's the main objective,
Yeah.
right? Because again, you got to look at the holistic view of why we're doing this. We want to buy some property that's going to give us good cap growth, got good cash flow. People want that. So are you really going to say no to a deal just because the interest rate is, 0.5 cheaper over here, which is not going to happen? Kill the whole deal. I've had brokers that have come and go as well because they couldn't get over that.
Yeah.
Right. And I was like, look, I don't think you're suitable for us and what we want to do because you're stuck on this point of, client wants a lower rate. Who doesn't want a lower rate? You know what I mean? But you got to see it in the big scheme of things, right? So do this, come back to a lower rate later on, whatever it may be. So I guess, problem solving is the biggest thing because every deal is different. Every client is different. What their wants are different. And just trying to put that puzzle together. We use so many different lenders. We don't just stick to, the big four, whatever. When I look at my book, I'm just like, oh my God, I've used nearly everyone because everyone has a different policy from time to time.
And I think that's a good sense to, with a sort of disclaimer message, everyone's lending circumstances are different. So you need to get the right advice for you, dependent on your particular circumstance. And, apologies, but, we're just a couple of guys talking about what you can do here. This is not in any way constitutes financial advice. I'm just but a humble journalist interested in mortgages. If you want to actually understand what's going on with your finances, you need to build the right team around you and go directly to a bank. That's cool. They'd be more than happy to take your business, but think about a mortgage broker as well. Tell them everything because then they'll get you the best outcome for yourself. But some ideas we've been chatting about today, and speak to your broker around it, see if it is relevant to you. Thanks for coming in, Son.
No worries,
It's
mate.
always
Thanks
good,
for having
mate.
me.
Scott, what's next for us after mortgage broker, accountants?
I was thinking of doing a bit of a statewide roadshow, so maybe get some 2 Queensland agents,
Okay.
or some Victorian agents, and just like drill down into some certain markets, the most popular ones. So maybe, let us know if you got any other suggestions, but that could be another 5 podcasts in a row potentially.
Yeah, I think that's really good. And a bit of feedback on the last podcast, and apologies, my fault. The quality wasn't great. So we're in the studio face to face here. So it should be coming in with high definition sound, sponsored by Dolby. But I think we were both remote last time we got together, and
a bit of a rush job that one.
Yeah, I can't. Where was I? I was in Melbourne, I think, somewhere. Oh yeah, that's right. I was giving Melbourne Docklands a hard time.
Smash
them. Yeah, they got to open a few more kebab shops down there. It's what you need at midnight. It's, anyway, there's a tip for Docklands. Get a restaurant that opens after 8 o'clock at night. If you're going to pack it full of apartments, people need to be fed. Anyway, like Docklands, great place to be. Get it, great place to be. Scott O'Neill, if someone want to sort of interrogate quiz you guys on this or Son or whatever? What's the best way?
Yep. So just info@Rethink Investing. If they just want to talk to the brokers,
Just inquiries at rethinkfinancing.com.au.
All right, there you go. You get a barrage of
Probably.
Yeah. Give me one of these lease
palm it off
stocks.
the other brokers.
Give me one of these lease stocks quick. But lots to consider, everyone. And remember, and we had a really good discussion. Check in with the accountant when you're sort of structuring with this sort of stuff inside super, outside of super. Talk about SPV, special purpose vehicles. It gets a lot more complicated. So make sure you get the right advice. This is Inside Commercial Property with Rethink Investing. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.